maybe the buy and hold forever strategy isn't the most optimal. It's certainly the easiest and laziest. It is the hardest to fuck up. And I was always like, I'm holding for 5 to 10 years. So like, why should I even like try to guess? But then when you do the math, could you minimize massive drawdowns? If you could minimize massive drawdowns, the math adds up pretty quickly. You could double, triple your stack over that course of 5 to 10 years.
Welcome to episode 45 of the Alfalfa podcast. Today we are talking about some sexy stuff, moving from being a lazy, passive hodler to being an active, professional trader like these two gentlemen sitting across from me.
D-Gen Spartan.
We have questions. Nick and I have questions, but to be honest with you, I am by far the most noob when it comes to all of this stuff. I am a passive, traditional hodler investor. Nick is very familiar with these concepts, but I think Nick and I would fall more into the camp of the entrepreneur who makes the time for investing, and you two absolutely are the goats at the table of trading.
Full-time traders.
Full-time, yeah. Exactly. It's your life. It's your passion. And one of the things that where we really got started, and people that listen to our interview on Bankless know this, is this whole friendship, this whole podcast started as us four friends going to a cigar bar in Old Town San Diego and meeting up every Wednesday for a guys' night, talking about crypto almost like 98% of the time, that and existential crises that we were having and the occasional life hacking. But a lot of it was crypto, and we'd have these really organic, fluid conversations, lots of questions, lots of sharing experiments that we'd undergone and things that we were trying out in the middle of that bull market, and we learned a lot. And so this is an opportunity for us, I think, to kind of bring that back, do that again, you as a listener, watcher, to be a fly on the wall. And there's just a lot of questions, and we're going to kind of walk through a day in the life of how you approach it. I'm super curious, the tools you guys use, the charts you look at on a daily basis, and how I, or anybody for that matter, including another professional investor or trader, might be able to pick up some tips from you guys. So all the way to an advanced person, but also to a beginner who might want to begin to venture into that world. Because I think one of the things that we're finding out is like, sitting back and being passive is not working anymore. And I'm also learning that the hard way. Anything to add to that teaser? All right.
No, that was well teased.
All right.
Thank you.
So let's do our Alfalfa round. We'll circle back to that.
All right, cool. So no changes this last week. Didn't make any moves. I find this market kind of fascinating because I think you can't decide if it's bullish or bearish. Maybe more on the bullish side. I don't know. It's what it feels like. Ray Dalio has those like 4 quadrants, the 2x2 matrix of like inflation and growth, whether each one is increasing or decreasing. And I was looking at some people's like measures of where we are in those quadrants, and right now it's like almost 25% across the board. Like all the indicators of looking at is inflation increasing or decreasing, is the economy growing or declining. It's mixed signals across the board. So I just finding it a really fascinating market, but didn't make any changes. Still have my puts on the SPY. They are underwater, but
for now,
for now. But like
what month and strike?
They're pretty long, like June next year.
Okay.
I take that back. There is some January, I think, of next year. Nothing too close.
Okay. You've got outs.
Yeah, no, there's outs, but I'm still net long. Again, I'm hedging the JP Morgan portfolio, so anyway, just finding it really entertaining and curious. I'm very curious right now.
Well, it's a tough market. I think like you're identifying the fact that nobody really knows what sort of position to take right now, and I'm seeing sort of point and counterpoint in every avenue I check down, and I think I'm still of the opinion that like the bottom can be in, the bottom could have been set, but that doesn't mean that prices can go down from here and maybe like retest those lows. And, I think when we were looking at the beginning of the bear market, we were talking about the midterm elections in November and how it's likely there's going to be a little pump going into the midterm elections. And here we are. And I still have that Druckenmiller voice in the back of my head saying, I closed out all my shorts. That was the lowest hanging fruit, but I will be looking to get back in. If the market allows me to short again, I will be looking to get back in. And I think like that opportunity has surfaced. I was following this guy, this other CFA. I don't remember his Twitter handle, but he was posting something today, and he said that this bear market rally, if it is one, would mark the steepest bear market rally going back to his measurement period, which is like 1970. So huge run. Like if it is a bear market rally, it would be the biggest. Then that might lead you to think that maybe this isn't a bear market rally.
Right.
Mm-hmm.
So what I've been doing is the same thing I usually do. It's just selling volatility. I'm selling calls on ETH. I'm selling puts on ETH. And we can get into that strategy a little later. But that's what I'm doing.
Ooh, I can't wait.
Yeah, I'd love that.
Yeah, I mean, I've been following a similar strategy to you, where I got like super long, but then I started selling a lot of covered calls and also selling puts. So I've been doing that on a bi-weekly basis, I guess, selling out of the money calls and selling like puts at basically a price where I'm like, I'd be happy to buy here, kind of YOLO buy here.
Low volatility to through the merge. Is that what you're thinking? Like that's why you're doing.
I kind of feel like the volatility to the downside is going to be muted through the merge. And if there is down volatility, I probably want to buy it anyway. And I would, maybe buy it at with leverage at particular points where I'm getting, getting exercised on these options.
This is great stuff. This is exactly what I want to talk about in our next segment.
But I mean, I have been skewing my calls like farther out than I normally would, because I do actually think that there is potential for like a really large move going into the merge or immediately after, or however you want to spin it. And I think people have forgotten now like how much these things can move like very, very quickly, because it's been so depressing for so long. But there's still like just an incredible amount of air on the Bitcoin chart above where we are. I could see a scenario where we go way up way quickly, and I don't really want to give that away. But to Nick's point, like I have been considering like moving my portfolio to more of like a kind of tails based portfolio, where like I kind of express like all of the upside via long call options, and then maybe hedge with some puts, but mostly cash, but with like a heavy long call option position. And that could be a crappy portfolio if we go sideways for a while, because then you get chopped up, everything expires worthless, right? But like it is hard for me to envision how we end up in a sideways market, I guess, over the next few months, which is maybe a sign I should consider it more heavily. But it does feel like it's going to be like a just absolute hated rally, ripping up to levels that people can't comprehend, or LOL, you guys are so stupid. I can't believe you didn't sell that bear market rally, and now we're at 700 ETH merge. Ha ha ha. So I could see both those things happening for sure. But the sideways
Murphy's Law, like
the sideways
ETH
kind of like
merge.
chop like through the merge and through elections is just not
Chop. Can we talk chop?
Chop?
One of the things I really hope we dig into in this episode is like
the lingo. You want to talk lingo?
Please, so much lingo. I remember it was like a year ago, and Steven was like, do you want me to walk through this chart and give you all the lingo, like candles and wicks and this and that? And I was like, yes, please, let's do this. So we should go into some of that.
I know how much Steven's up on his long, because he's using his laptop as a coaster right now. So Jesus Christ. This guy coaster.
I'll get him a coaster.
All right.
We don't have to get him that.
It's a perfectly good coaster.
All right. You good?
Yeah,
May I?
sure. Why not? Go for it.
So my alfalfa for the week, always a little different. Been thinking about something really important. I had like a profound moment about a week ago, and there's a famous idea by a motivational personal development guru from back in the day, Jim Rohn, that you are the average of the 5 people you spend the most time with. And I don't know if this comes as a surprise to you guys, but I spend a lot of fucking time with you guys.
Yeah, joke's on you. You have to spend your time with us.
So my life is going downhill. No, the real alpha here is obviously spent a ton of time with you guys and super grateful for it. And my life has leveled up in so many ways as a result of that. And probably the 4th person I spend the most time with is my wife. And she's incredibly smart and kind and has a huge heart. So that makes me better. Nice job, Armand. But the 5th person that I spend the most time with by far, I've been realizing lately,
Mushi.
is our Discord.
I was gonna say that was your dog.
He is a person to
Hey.
me. He is a person to me.
There it is.
He is a person to me. But our Discord community is actually one of those 5 people in my life. And one of the things that I've really started to realize is like, first of all, I approach this community not as like I'm here as a host and I have some sort of like role to play, but I'm very much there just the way every other participant is. I'm there to learn. I'm there to ask questions. I'm there to share. I'm there to laugh. And I'm having an incredible time. And I've started to realize that actually this wider Alfalfa community as a whole, whether they're in Discord or not, or you hit us up on Instagram, has started to impact my entire being. My mind, I'm asking better questions. I'm looking at the charts differently. It's part of my extended mind, and I'm super, super grateful for it. And there's a lot of people also that are in the community that are super, super grateful for it. Shout out to Hookem, who I copied.
He's actually typing right now in the Discord.
No way.
Yeah.
So I pulled up this comment from him. He said, and there's so much like positivity and love and recognition of the same thing that I am describing right now. And he said, there might be a couple of like these Lord of the Rings fan fiction Discord groups out there that could take us on pure IQ, but I will bet all my ETH that this community scores higher than any other on IQ and EQ combined. Just in the last week alone,
Hell yeah.
we've been describing tanning your perineum, your butthole, discussing the gender pay gap in a civil way. And there's women in the group that are bringing their opinions and thoughts and ideas. Shout out to Anna, shout out to Basil, like all these people that are just bringing Paradox, such good conversations. How to make a world-class old-fashioned. And all of this is just making me a better person. So I think one of the things that I didn't know, my alfalfa really is that I didn't know that through a community that you could grow as a person and that could be an extension of your friend group. I'm super fucking thankful for that. And I really mean it. These people are like one of my 5 people.
Amen.
Love it.
Yeah.
That's beautiful. Thank you. I always wanted Alfalfa to be like an intellectual shit show.
Cool.
I think we're
An intellectual shit
yeah,
show.
we're doing a good job. It's
Cool.
just like all over the place. I love
Good.
it.
Oh, I have one more thing. So we did the happiness episode, obviously. People have heard that by the time they're listening to this. And I think I might have an updated formula. I've been sitting on it for a little while since that episode, and I felt like Eric and I landed in a very similar place, but I had a huge unlock last night, and I was discussing it with my wife, and we were going deep on this, and I think I have something, but I can't bring it until I've really put it to work.
Teasing,
So this
teasing
is
a
teasing.
future
So this is
alfalfa round?
non-
Hey,
Alpha?
some people wanted, what are you going to be working on this week? So yeah, I'm going to be working on a new happiness formula. And I think I missed something critical. I think that, to tease it a little more, I think that there might be a happiness that is beyond just peace and contentment and that revolves around the idea of bliss. And I think that there is a path for us all to get there.
Cool.
So let's go into it next time.
Okay. So,
Yeah, I have a lot of follow-up questions that I'm not going to ask. Right now,
so that's your segue into our tools for
Sure
trading.
is. Tell me how to make money. Fuck segues.
So
All right.
can this be a
So
little
how,
bit of
how,
a
how to not be blissful?
Yeah. Nick, go ahead.
Well, I was gonna say, can this be a little bit of selfish?
Of course.
I'm just gonna ask questions for myself.
No, that's what this is.
All right, good. All right, so where should we start? Do you have a place to start?
I don't.
All right, well, I kind of have a place to start. So I think I'm where Steven was at kind of last cycle, or where he kind of learned this, I guess, pre the last bull cycle, where he was thinking, well, maybe the buy and hold forever strategy isn't the most optimal. It's certainly the easiest and laziest. But as
The hardest to fuck up too, probably.
it is the hardest to fuck up. And I was always like, well, I'm holding for 5 to 10 years. So like, why should I even like try to guess? But then when you do the math on like, could you minimize massive drawdowns? If you could minimize massive drawdowns, the math adds up pretty quickly. You could double, triple your stack over that course of 5 to 10 years. And you don't necessarily have to time the top, by the way, especially in crypto, when you have 80% drawdowns. If you get within 20, 30% of the top, it's a good place to potentially minimize those. So that's why I've been trying to like, in the last couple of years, like understand macro a little better, understand trading a little better, indicators I could use. And so that's what I kind of want to like dive into with Eric and Steven a little more on like, what tools do you guys use? And like one of the first things I wanted to go into, if you guys are okay with it, was like, you know, I think a lot of people fantasize looking at charts because like hopefully within this chart there's lines and curves that could tell me the future. And I don't think any of us agree that that's true, but it could tell us like the possible outcomes maybe, and when to know when ones are more likely than others to happen. So I use TradingView now to look at my charts, and the charts I look at the most are ETH BTC and the ETH BTC ratio. The indicators I have are the RSI, the volume profile, the 20-week SMA, and the 200-week SMA. And then I do look at like equities in the morning. I look at like, the SPX, the VIX, the oil. And then on macro, I've been trying to look at like net liquidity, that general economic calendar. But back to the charts, am I missing any like big indicators I should be looking at? You know, like is TradingView the best tool to use and kind of set up a way to view price and price action? I'm curious what you guys use.
I mean, I use TradingView. I've been thinking about using some other tools like I know ExoCharts is pretty popular, and there are tools that are similar. Like there's some data out there that it's really useful if you want to be a shorter term trader. Like for example, if you want to look at something like cumulative volume delta, CVD, and to look at the sort of individual changes in like open interest in conjunction with that on like perps versus spot, for example. Like there are people who trade these kind of order flows, and if you have like a shorter time horizon, like you can kind of like FTX has had this habit of basically like sort of like pumping price with, you know, perps and then distributing spot and just doing this like over and over again. And people who trade this like pattern have been doing pretty well. It's not something I do personally, but if that's your style, that can be good. Like I don't really like it because I am still like mostly longer term oriented.
I look at them mostly on the weekly chart. Mm-hmm. Eric, what do you look at?
Can I reframe a little bit?
Sure.
And the way I want to reframe this is that we're talking about trading as one thing, and it's not. Trading has many components up like within trading. So there's high frequency, there's arbitragers, there's distressed asset traders, there's, you know, like they come in many forms, and each different type of investor trader would use different tools.
Okay.
So when you're asking me, I'm like more of a traditional, like value, fundamental based investor, which probably aligns more with like a Hodler. But yeah, to your point, TradingView is a great tool. But I don't think that is necessarily the tool that I rely on most as the fundamental investor that I am.
I think it's an important thing for people. Like there's probably a lot of people who get into crypto and they use like CoinGecko or like CoinMarketCap, right? And they look at charts on there and they don't even know what a candlestick chart is, right? It's like a huge like, to like realize that candlestick charts are a thing because they give you so much more information versus a line chart, because they, you know, line charts just like, I don't know, the close price or however it does it, right? Whereas a candlestick will show you the open, the close, the high and the low with a particular time frame, and you can garner a lot of information about what happened with that big or small candle in the range versus just like a point, right? So that's like a big level up for a lot of people. But I think TradingView is, I use TradingView for crypto. I use it for macro stuff. I use it for a lot. It's just so versatile in what it gets you, and it's so cheap or free even if you're not using a lot of indicators. So that's got to be like one of the number one tools I think to put in your arsenal. Like probably for most everybody I can think of who wants to be somewhat active, like it's definitely a good thing to level up with. Do you use that, Armand?
I not often.
I pay for the basic level of trading.
I don't even pay for it, but I want to go back to Nick's question just to make sure that, because I have the same question. Are there any other indicators that you guys look at?
I don't use a ton of indicators, to be honest. I actually have mostly use like a 20 and a 200
though. Do you have like a, you know, you wake up and
it's almost like the wrong, like I want to interject here and I want to get a little spicier because I actually look at all this stuff as dog shit, pretty much. Like I don't like charts at all. I think they're bullshit, frankly. I think they can be used for a specific type of trading. Like this is
So when would they be useful though? When would you be like, I want to look at the chart a little
like
bit?
a common adage amongst like the fundamental investor is that common adage is like the fundamentals will tell you what to buy and the technicals will tell you when to buy.
Okay.
That's like a common adage. I like using like in traditional stock stuff. I like using moving averages, particularly like a short-term one against a long-term one. You look for the crosses. I like watching RSI, MACD, and these are applicable to crypto as well. But like this wouldn't be what I make investment decisions based on.
But let's say,
necessarily.
but in the case where you like, I know I want to own more ETH, then you might tend to look at that chart then, right? To see like, okay, well, when is potentially a good time? Or are you looking at more momentum and swing and narratives?
No and no.
Okay.
I think it's interesting because, so let me differentiate.
Okay.
A fundamental investor is looking at, and this is straight me coming at you. This is not like something I was taught or I learned. This is like through observation of my own. And I think like it comes from a place that Warren Buffett once talked about. He said, he was talking about value investing because like he was always described as a value investor, right? Warren Buffett. And he's pretty good. And he goes, well, this is the stupidest nomenclature I've ever heard because who in their right mind isn't buying something expecting some positive outcome, some value, right? Everyone's a value investor at the end of the day. So the nomenclature's stupid. I want to put my own labels on it. I think of fundamental versus technical, okay? And the difference here is a fundamental investor prioritizes a narrative, okay? So let me describe that a little more. Like Apple, for instance, is coming out with this brand new device. It's called an iPhone. This iPhone will result in higher cash flows for the business. The stock price will reflect these higher cash flows. So it's a narrative first ideology versus technical analysis is like you're looking at price action, the lines, the dots on the chart, and the price action determines your actions. Like price determines future price. And that's what separates technical versus fundamental. I'm a fundamental investor.
You're a fundamental. Okay.
Yeah.
So like I wouldn't use lines on a chart.
It sounds like you rarely use them.
I know how to use them. It's just it doesn't really drive my decision making.
And Steven, you use them. I think you use them more.
I almost entirely use lines on a chart.
Okay.
The degree to which I use lines on a chart exclusively is like proportionate to my time horizon, right? So there's stuff I bought like ETH, right? Like I don't mind bag holding ETH for a decade. I will make investments on that based on the chart, but also based on fundamentals and stuff, right? But I don't have any problem like putting on a Dogecoin trade. There's no fundamentals to. There's no discounted cash flows.
In Eric's definition, there's a narrative.
It just means
potentially,
narrative.
Right?
I use that term.
I
precisely.
agree that there's a narrative, but like and I agree that oftentimes price creates the narrative as opposed to the other way around, which is why I think charts are actually really good in crypto. I think we need to differentiate too between. There's this popular saying, right, that like what is it? TA is astrology for men, which I think is kind of hilarious and true, right? And where I think it's true is like when people have like 900 indicators on their chart and they think there's like a magic indicator that when it turns green it means buy and when it turns red it means sell and that's it. Like I do think that is largely bullshit, or at least the simplicity of that. Like I know people who do trade using technical indicators like moving average crosses and stuff, and they do well with like a particular trend following system.
Probably
so
Rizzy in our Discord.
Yeah,
probably.
Rizzy. I know Rizzy likes that, right? So I'm not going to poo-poo on that, right? What I like about charts is that they let you study like price action. Like a chart shows you where there is liquidity, where people are buying, where people are selling. There is a tendency for price to return to where there is liquidity. Like you can use this to your advantage if you know how to like read this, right? And there's different levels of being able to do this, right? The most basic level is to look at there are people who just start trading crypto and they don't look at anything other than the price in their app. Like, oh, Doge is 58 cents. What does that mean? I don't know. But like if you can pull up a candlestick chart and you just look at it and suddenly you're like, oh, this was a tenth of a penny like a year ago. And you see like this price is just trading up in the stratosphere. There's no history here. It's like, and they're like, oh, where did it last trade? Oh, 99% down. Oh, that's where the most demand was. Okay. Like, so you have something to like anchor yourself to, right? You have a realistic expectation of where things can go. And this is especially useful, I think, in like bear markets for altcoins, right? Because they all tend to do the same thing, right? They tend to just completely capitulate and then they just go sideways for a while, right? And if you're looking at a chart, you just see this line going sideways and flat for like a year. You're like, all right, maybe I'll take a flyer here. Like some of it, like when I do it, it's not like ultra scientific, right? But a lot of people, I know I have friends who trade crypto. They've never looked at a chart ever, like a real chart, and they're just totally driving in the dark because they have no perspective on where price has been. And if you don't know where it's been, then it's hard to know where it's going. That's kind of like 101 stuff, which I think is really useful.
Okay. So you guys also have mentioned some other tactics and techniques, and I've used them before, but I think you guys have used them more often, specifically like perps and options, and in what case to use them. So maybe we can have a little discussion about like when to use both. And I'm mostly using them as like when I have two questions. Like when I fully believe in something and I want a leveraged trade where I want capital efficiency, I guess. And then other when I'm hedging. So I think Eric, you probably be a good place to start with options. Like when are options a good tool? And you even mentioned the Alfalfa Round. You used them in a specific way. So maybe you can use that as an example or talk about that a little bit.
So a couple things. One, I kind of came out strong against technical analysis, and that is what I believe. But I also, I don't want to use it personally, but I do see some value there because every price on a chart represents a transaction, like a real transaction. So at some point, somebody was buying and somebody was selling at that price, and that there is some information to be gleaned from all of these transactions. That's true. To your point, like where I want to use price is basically I want to see what the volatility of the pricing is, because when I'm doing options trades, all I really care about is where could this go?
Okay.
All right. And what I tend to do is, like we talked about this in the last episode, we all tend to be like long biased, or at least the three of us tend to be long biased. Steven flips from being net zero or net neutral to being fully short or fully long on a whim. But like most investors have a long bias, meaning they buy things and hold it. They buy things they like and they tend to hold it. Okay. So when you're like a long biased investor, what you can do with options is hedge your position, or you can use your long position to generate yield. And I'm typically using options to do both of those things. You also mentioned leverage. In crypto options trading, at least the platforms that I use today, they don't even offer leverage on the crypto platforms. So this is a TradFi options strategy. In the perps, you can get the leverage.
Okay. But wouldn't you consider, so I kind of consider options sometimes as like a form of leverage, like where you can capture volatility and have like much higher, I don't know if beta is the right word, but so like your position moves up and down a lot more.
This is because you've used TradFi options, and each options contract represents 100 shares. In crypto, these things are fully collateralized by your cash or your ETH.
I see. Okay.
So when I'm buying or selling options on ETH, like this goes back to my fundamental investor mentality. I have a view of this asset and a view of where it's going over a long-term time horizon, right? So I like ETH, right? We all do. So with that as my North Star, I can then create options positions to enhance my long ETH. Okay, so what I'm going to do with ETH right now, ETH's at 1850. I even tore off a page of my notes today, like from my actual desk today, because
that looks like one of those things you take to class that has like
this is like cheat sheet. No, this is like the tortured genius thing where he like wrote down a polynomial formula on like a piece of paper. It's not organized at all.
Get it out.
Yeah, this is the full boomer in me. Like I have a 70s mustache. Like
it's on a lined college ruled piece of paper.
I only write things down and use Excel.
He even has the binder holes. Weird.
Yeah. Binder.
So what I'm doing here is I'm calculating the expected one standard deviation move on Ethereum using price, right? So in this instance, I actually like price because price volatility is going to tell me what the options implied volatility really is today. Okay, so when I'm looking at ETH, I was looking at the October 28th strike. And what the implied volatility told me today, when ETH was at 1850, is that there's a 16% chance that in 73 days, ETH will be above $2,821. There's a 16% chance that it will be below 879. Okay, that's what the market's pricing in.
Okay.
And then I take my own view and I compare that to what the market's pricing in. I said that there's almost zero chance for me that ETH is below 879 in the next 70 days. So I want to sell that put. And back to Steven's original point is like, if I lose this contract, specifically the one that's settled in Ethereum, like if I lose this 879 strike, like, or 1,000 strike, or 750 strike, like whatever point is near that, like if I lose that, then I just have to buy ETH, like I'm forced to buy the dip. So I'm getting paid an option premium. I'm getting paid today to buy a dip later. This is a no-brainer for me. And then I can like take this on the upper bound. I can take the 2,800 and be like, well, I can even go extend to that. I can go to the 6,000 strike, sell that, fund me buying more ETH.
Are you looking at like, okay, well, that's what the market's pricing in. Let's look at 3 standard deviations away, and I'm happy to sell those calls because 99% chance that this isn't gonna happen.
Absolutely. And
which is what you have always done with
this is like
TradFi as
this
well,
is my
right?
whole TradFi business. And like, here's a good example, like Bed Bath & Beyond's up 100% over the last 5 days.
Oh, if you were selling those calls, that'd been brutal.
Exactly. But now that it is up 100%, now maybe you sell 3 standard deviations off that now, and
people are willing to pay pretty hefty premiums for those calls right now.
You collect the premium on that. And if it hits 3 standard deviations from where it was today, already up 100% in 5 days, well, then you're happy to short at that level anyways, because things tend to revert to the mean, like especially shit things like Bed Bath & Beyond. So like I'm doing that for all asset classes that I either like or dislike.
Can you give me a rough amount, how much you're earning on selling those puts, like below 870 or something like that?
Yeah.
Because that's interesting.
Yeah. So those were earning $70 on the strike of 1,000. So about 7%. And,
what's the expiration?
October.
Okay. So you're going to earn 7%
for 70 days.
Yeah.
And then I'll just hammer that. Keep it going. And then when that expires, either worthless or I'm put to it where I own ETH, I'm happy to own ETH at that price, right? We all would. Then I can just roll it over. Hopefully implied volatility is still high where I can just capture more yield.
And you mentioned in the Alfalfa round that you're playing low volatility. So by essentially selling the call and selling the put, you're saying this is going to be a range in which it's going to operate within, right?
Yeah, sort of. But like I go back to this fundamental investor mentality. Like when I'm selling the call at 6K strike, what I'm asking myself is, am I okay selling this ETH at 6K in 70 days? And for me, it's like, that's a pretty good return for 70 days. I'd be happy.
They're all covered
With you have to
have the ETH in there. Obviously, it's decentralized.
In the crypto
right?
options. You have
because I've never traded crypto options, only in TradFi. So this is where I'm
in
learning.
TradFi, you can get burned if it really bursts through.
Yeah.
But in crypto options, you're always covered.
And in 73 days, you probably should sell if it hits 6,000.
That's my whole point.
Right.
It's like you'd want to take some profit here.
Anyone else have any questions on options before we move on? I was going to
love that,
ask next about perps.
It's good shit.
Yeah.
Okay. So
perp me up.
yeah. Question to Steven. When should I use perps? And maybe the proper question is like, what time frame are we playing in when we're using perps?
I mostly use perps for capital efficiency. So I might say like, oh, I'm 20x levered on this position, but that doesn't mean like my whole account is like 20x long. It just means like the money in my exchange wallet is 20x levered, but I may have like a bunch of collateral on chain that I can move over, right? So a good example of when to use a perp, right? So if you're really long spot ETH and you're sitting on like a bunch of gains and you're like, God, this price has run up so much, I don't want to be long here. Well, if you sell your ETH, your spot ETH, you've just created a taxable event, right? You got to pay gains on that, right? Another alternate play is to just to hedge so you don't have to sell and realize that. Now, you might be creating a gain if you end up making money on the short. Maybe that's an ordinary income thing. But like depending on like how much ETH you wanted to sell off, like you may be sitting on like a fat gain. You're like, I don't want to sell this, right? So that's a good example of a good time to use a perp. I also tend to build like I want to be long-term long like ETH and Bitcoin and, you know, primo stuff like that, right? But I still want to like degen on random coins, like if I see opportunities. So you can use like Ethereum as collateral and take these like small, shorter term swing trade shots at like whatever dog coin you think is going to pump over the next month or something like that. That's also like a thing I typically do. I don't know. I love perps.
Well, can I ask like a question that I was asking myself in the last few days?
Yeah.
So let's say in the next year and a half, ETH goes to like 12,000. And I'm like, maybe at that time I'm feeling like this is either near the top or it's feeling toppy. And I have a big old bag in USD value of ETH. But is there a more tax efficient way rather than just selling it or selling the majority of it? Could I use either perps or options to basically go neutral at that point? And which is the better tool to use in that scenario? So let's say I'm up gorillions of dollars and I don't want to sell and pay taxes. I just want to like use some chunk of that money. Maybe I have to sell a portion of it in order to buy puts or to go short perps using a perp. Like which one is the better tool to use in that scenario? And keep in mind that like it may be a year, you know, it's a longer time horizon that you might.
I think the answer to that is probably the perp in crypto because of the leverage. So you could take a smaller amount of money, lever that short position, and then cover your whole spot bag.
So let's say I sell 25% of it.
Right. But in TradFi, you do that with options because it is a levered security.
Okay, but what about the funding rate? Because like the funding rates in perps change all the time,
Depends on what
right?
the funding rate is, right? So if you want to hedge and you want to get out of your position and the funding is in favor of the shorts,
You might actually get paid.
you're getting paid. Yeah, then it's like great. Like and at the top of a bull run, funding is usually super positive, which means that shorts are making a nice hefty premium. So that's like a win-win for you.
Do you find anything to be sort of like instructive about the funding rate? Because, you know, that could be used as a signal perhaps, like people are getting a little too offside.
I honestly don't use that for anything. I think there's something to be said for analyzing like the changes in open interest and that sort of thing. Like if you understand how to analyze those flows, like I said, it's not something I would consider myself to be like a super expert in, but I think that's where the alpha is if you kind of understand how to do that. But
All right, I got a next additional question. That same scenario. Okay, so let's say I go, take 25% of my ETH, and I put that in perps. I go, well, I guess I'd have to go 4x short in order to like go neutral essentially. But there's a liquidation price. Is there another hedge I could do to protect that liquidation price? Like either using options or an additional
how
position?
how would you get liquidated?
Well, if the price kept going up.
But wouldn't your collateral go up proportionately?
But I don't think
I'd have to do the math on it. But
you have to have a separate account. You can't lever up on a position that's already collateralized.
Right in the same.
Well, if you have like $1 million, I'm just going to do this out loud, I guess, because if you have like $1 million of ETH in your account and you want to go 4x short and just use 25% of it, yeah, I think like I'm gonna sound like an idiot if this is wrong, but I think like whatever proportion, like you're like I do this all the time where I short and I have collateral, and like typically like the collateral is going up, you know.
So it should equal out
while you're
essentially like if the
where you run into trouble is if your collateral is like stables and then you're making like a long position, or you know like when the things don't move together, you're longing or shorting with different types of collateral versus what the position is, then you can have this like kind of like rapid like, oh god, you just got liquidated faster than you
let's say
anticipated.
in that scenario I take 25% of it and I go 4x short, but if it all goes up by a third,
You would just
I would get liquidated, but I would still be
you'd
whole.
still be net neutral on the holistic portfolio, or you could just move ETH from the other account to cover
collateralize.
Yeah, to
Okay.
recollateralize. Yeah.
Okay, understood. And then so with perps though, I always looked at them as like a short-term option. Like holding them for a year sounds dangerous, but is that just maybe a myth that I kind of hold in my head that it actually could be used as a tool? If like we're going to go into let's say we go to 12K and we're going to go to a year potential bear market, is it okay to hold that for that long a time? Because I imagine the funding rate's going to swap. You know, if the market goes bearish, then I could be paying quite a bit of money to hold that.
I mean, I don't know what Steven's going to say here, but I've used perps for, maybe a year, and I feel fine about the funding rate.
Okay.
Just sort of like, I almost eliminate it from my analysis because like it can move against you, it can move for you, but at the end of the day, it's like that isn't the move that I'm really like optimizing for. So I'm fine holding perps.
Yeah, you have a funding rate, quote unquote. Like if you go short, like you say you want to short a token and you borrow it on Aave and sell it. Well, there's a funding rate, quote unquote, on that as well. You're borrowing the coin to short it. You're always like basically paying a rate to borrow a coin and short it. It's like perps. Sometimes though you actually get paid to short, so it's a little different.
Okay.
I've never held a perp for a year, and especially on the long side, I would prefer to hold spot for that particular duration. But like I suppose you could do it.
Okay.
So how about like for a hodler, let's say Armon, for instance. Armon holds ETH, and let's say you want to just like enhance your ETH from like a return perspective or a risk perspective or both. Mm-hmm. Like how I would use options in your case is like pretty straightforward. You're going to hold your long ETH still. You keep that. And then you can sell a call against your ETH and capture a little bit of a premium. Let's just say you sell a level that you're comfortable with over, like, let's use the 70-day period, 6K strike. Like at 6K in 70 days, you'd be like, I'm going to take a little bit off the table here. That's totally fine. Okay, so you sell the 6K strike in October. You take that money that you receive immediately, and you use that to buy puts against the ETH at even a tighter strike. Like that to me makes a lot of sense. That
So
way,
instead of the 800, you might buy it at like 1200, for example.
sure, or
Okay.
15 or whatever.
Okay.
And like in that way, you're at least protecting some of your downside, and it's free. Like, and you're taking, like, you're saying that you'll take some off the table at 6,000.
Right.
And I think you got to find the level for a fundamental investor like me. What I'm saying is like, I'm identifying in advance what level I want to take off the table or buy more. So like, when I'm selling puts, I'll say I'll buy more ETH at 1,000 or at 750 or, whatever. And then I'll sell those levels and capture the premium.
So you'll take that premium and then use it to sell a put?
Depending on what I'm feeling as a fundamental investor.
Okay.
Like, I think for Armon's sake, probably the easiest way to do it is just sell covered calls and either reinvest that into more ETH, which you can do, and these yields far outpace what you get on Lido.
Interesting.
Or
versus staking, you're saying,
yeah.
I mean, you're right. You got 7%
And
in
we're
73 days.
Right, and 73 days is a lot less illiquidity than we're talking on Lido. I guess Lido you have like liquid staking, but
Still.
for staked ETH, let's say. Let's just say that instead you want to buy put protection with that premium. Well, now you have like a little coverage on the downside. That's also enhanced.
So you're enhancing returns, but you're also maybe mitigating risks. So like your risk-adjusted return is higher because of
I
those.
think the Sharpe ratio
tactics.
improves for sure. But
God, I feel like we need to just do like an entire options episode.
This is good.
I get this went by so fast. I feel like we've barely even touched on some of the.
I still want to
basic
keep
stuff
going if
too.
you guys can. I have some more questions.
I mean,
Okay.
like, I feel like we should take a step back first and touch on something that's really critical, just in case you don't bring it up. If you're a long-term investor, this is sort of like less critical, but the more you sort of are doing shorter-term stuff, and the more you want to start using leverage, which I don't really recommend for people who don't know what they're doing, but like it's very like the step one is like risk management. Step one when you get into a position is to know where you're wrong. Like if you're trading, you don't want to be in it for the tech, right? You want to be like, I'm wrong on this thesis. I'm selling the coin. I'm out. You want to know exactly where you're wrong and why you're going to be wrong there. And you want to know like how much of your portfolio you're going to lose when you're wrong there. right? Like, so traders will risk a particular amount of their portfolio per trade, and that might be like 0.25 R up to like 2 R, right? And like where R is like a unit of risk in their portfolio when they take a trade, and that might be 1% or 2% if you're like pretty aggressive, or 5% if you're like
of
a
your
lunatic.
entire portfolio.
Of your trading portfolio, not like your net worth.
Sorry,
you know?
your trading portfolio in a single trade. So it might be like a 20% stop loss on a single trade, but that 20% loss represents a potentially
Yes.
2% loss in your total trading portfolio.
Yeah,
right?
and this is where leverage is useful, right? So you have a $100,000 trading portfolio, and you're willing to tolerate a $2,000 loss on a position like that you have a lot of conviction in. You're willing to tolerate that much of a loss, right? You may be getting into a trade that's like shorter term. The price isn't going to move a lot. If you just spot long with even your entire account and capture like a 0.5% move, that's kind of like that's not going to do it for you, right? So by using leverage, you can sort of scale the position up to the point where like, okay, if I'm wrong here and I lose 0.1%, well, that actually means I can go 20x lever right here for 2%, right?
Right.
And if your upside is like, say, like 8 times that, that's what a lot of trading is, right? It's not about being right more than half the time. It's about making way more when you win than when you lose, and like keeping your losers tight and then like letting the winners run, right? And like that is like a whole another thing, right? And like how often do you take profits and where are your targets? That's like that could be a whole hour by itself. But like for most people, they have to get this like main concept down. You have to know when you're wrong and how much you lose, and you have to know how much you're risking on each trade. Like take care of the losses first, get those out of the way, and then the winners kind of come. Like people get into it and they get wrecked because they don't think of that. They get into a position without thinking about where they're wrong, and then they just keep going like, oh my God, oh my God, oh my God, oh my God, it's going down. And then next thing you know, they're just like, they don't even know why they're in the trade, and they lose 25% of their account on one trade. And then that's just like death for you.
So you bring up a good point, and I want to actually revisit the options play as well, because I like when I'm talking about it, to your point, like making a small percentage doesn't appeal to most people. Like it only works when you have a lot of money, really. Like, so I'm making 7% out to October. Great. Actually, that's like phenomenal, because when you annualize that, that ends up becoming like a 30% return on an annualized basis. But that still doesn't even move the needle for, Jimmy or Johnny or whatever, right? Like 30% is cool. Like they need 100x return.
Right.
But if you have $1 million in ETH long, well, now, making 7% is appealing, and, everybody wants to sort of buy the $1,000 dip anyways. So it's different for different players, kind of.
Mm-hmm. Mm-hmm.
I wanted to switch to a little like macro metrics, just like understanding regime changes. If that's okay. If anyone wants it's okay to move on.
Yeah.
So, I have a few metrics that I've been using, or that I've learned over the past year, that I want to use next time when we get. I guess I kind of used them in this bear market, but I kind of want to be aware of like when we switch macro regimes. And so I've used a few. I mentioned it when we recorded on Bankless. Like the 200-week moving average is a good, decent one. Maybe it may be less useful in the future, but like in this little downturn, when the price moved below the 200-week moving average, it was probably generally a good time to buy. But also this metric I've been looking at more is the net liquidity. And the thesis is that crypto specifically, because it's so far out on the risk curve, that it responds and correlates more to like liquidity in the economy the most. And so I'm kind of like, when I'm looking at everything from a broader, spectrum, from total crypto market cap to like ETH, BTC, I'm trying to understand like where is net liquidity going. And so that's been the one I've been trying to learn the most and understand.
Good.
Okay, good. Okay, good. So, and maybe I should define net liquidity. Like, I think most people understand the Fed balance sheet, whether they're doing quantitative easing or tightening, but there's also a few more calculations to it. There's the reverse repo, right? Like the account, like, and then also the Treasury general account.
Yes.
And so you can, add or subtract those all together to get net liquidity in the economy. So I guess, is that a good tool? And should I be looking at other macro tools? And I'm speaking mostly to crypto, not to like equities or anything like that. Like, what should I look at for these big turns, either big from the bottom up or from top down in price?
I mean, like global net liquidity is the kind of thing I'm trying to figure out the most. And I don't know how to do that super well.
I've never seen a chart for like global.
It's a lot more complicated than just United States net liquidity, and it's a good proxy because obviously we run the world to an extent, and it's just those simple, like as far as I know, it's just Fed balance sheet, Treasury account, Treasury general account, and the reverse repo. Like if money is in reverse repo, it's not circulating through the system. There's less money circulating through, right? So in like this is like a big thing for people because people were just purely looking at the Fed balance sheet, and it was an okay metric as a while, but then the reverse repo numbers started just exploding so much.
It's over $2 trillion right now.
Yeah, and it became like kind of just silly to just look at one of those things in isolation because dramatic changes in either of those other metrics could just totally, like you could have the balance sheet here and liquidity's up and the balance sheet's the same place, but now liquidity's down because of these other things changing.
Right.
So that's something I definitely have an eye on and I'm concerned with. That's like my number one concern. Like, is liquidity on net going to drop off? Is QT going to do what they said it's going to do? Because it kind of hasn't been, right? Like liquidity's been increasing.
Since mid-June.
Yeah. And, Ethereum price coincidentally has been increasing since mid-June. And I think like a lot of Ethereans are a little delusional as to how much ETH is actually decoupled. Bro. Yeah. Like
I'm like, it's liquidity. Like look at it going up. So
I love the merge as a narrative, but in the short run, do I think like that's like really going to like, hold the world up? No.
And do you think liquidity is going to continue going this way?
And that's something like, I don't know how to predict that. I have seen that there does seem to be a lag in the data from what I've seen. Like it does seem like if liquidity goes down, there is like a little bit of a lag before prices tank. So if you can pull those numbers, and I'm trying to figure out how to get those numbers in a simpler way than like manually pulling these data points from the Fed site, pulling them into a spreadsheet, and then like charting them constantly.
I don't want to get too in the weeds here, but like in terms of net liquidity, like there are some predictions you can make because like the Secretary of Treasury does give guidance on like how much they're going to keep in the Treasury general account, right? So that could be used to like hopefully predict that portion of it. In terms of the reverse repo facility, like you could look at the rates that they get and in relation to what banks could potentially get elsewhere to potentially predict that, correct? Or
so if rates are going lower, there's more liquidity in reverse repo is what you're saying.
Well, I guess it seems like the Fed determines what the reverse repo facility provides in terms of return. And they generally keep it like a handful of basis points above the lower range of the Fed funds rate. And that is like it is in fact a risk-free way for the bank to hold collateral. Right? Like that's how they can get a return rather than lending out the money and using it in the market.
Yeah. I mean, I want to keep diving into this. I think we could dig through it for a while. I feel like it's probably just going to get a little too in the weeds and off the path of like just the basic trading stuff.
So net liquidity good.
Net liquidity good. Pay attention to that metric. Okay. Figure out how to get it and track it. Very, very good.
So the 200 week moving average, net liquidity. What else in terms of like big shifts?
I mean, the other one is that like crypto is basically like high beta NASDAQ. Like that's a thing people like. I think we take for granted that we understand that. There might be people listening who've never thought of that concept. And that's like, you're mostly trading kind of like a leveraged version of the NASDAQ when you're trading crypto right now, right? So if you're a trader and all you do is chart Ethereum, you never look at like the S&P or the NASDAQ charts, you're kind of missing the point. Like right now I'm like looking at crypto and it's kind of sketchy. But when I pulled up the S&P chart today and I'm like, damn, this thing looks pretty good.
I think you're dead on, and I think you're hitting on something that I've noticed. It's like you have this like overall risk curve within like the investable universe, which includes like bonds, and then you go up to like blue chip stocks, and then out to riskier stuff like crypto, and then like within crypto there's a risk curve with like Bitcoin and ETH sort of at the lowest end of it, and then you get to like shit coins on the far end of it, and I think like you mentioned, you see Doge pumping today. You see like within the stock universe, you have like meme stocks pumping. This might lead me to be like, well, is this kind of getting towards euphoria moment where like the highest end of the curve, like the riskiest shit is raging? I wouldn't sell that moment right now because it can rage for a while, but it's something to keep on your radar.
Yeah, and to get back to like the moving average stuff, I think it's a good sanity check, right? Because you can pull up the Bitcoin chart and look at like the 50 week or the 100 week, and you're like, God, we're really far away from these things too, and that would be considered just mean reversion to get back there, right? So when you're way below it and you're thinking, oh, this rally, I don't know, like you could actually zoom out and be like, actually, there's a plausible case that this has more legs. It's just kind of getting back to kind of like a longer term equilibrium if you spin it a particular way. That's a useful way of like using those lines on the chart to sanity check. And I know that a lot of people like to use the 20 week in particular as like a bull market symbol. And like Ethereum, like today I was looking at it, it's actually
You just butted up against it.
Yeah, it got rejected multiple times from the 20 week, and it's currently kind of like compressing between the 20 week and like a pretty critical support area, right? So you would expect this also might be a good time when you want to trade options, right? This is another thing people have to understand. It's like you don't have to bet on price go up, price go down. You can just bet on volatility, right? So if price is being squeezed between critical areas for a while, well, you could either buy a FTX token, like a ETH move or something, like the move tokens that they have, right? Or you can just buy like a straddle or something. You can buy a put and buy a call, and you're just betting on volatility increasing. So that's another play you can have in your toolkit.
Do you assign any alpha to sort of like known winners selling bags? So like you can follow, like in traditional stocks, you can follow 13F filings. These are like asset managers or whoever.
Ducask or whatever, like Druckenmiller's like trades every 6 months.
Duquesne or Cassandra. Michael Burry just sold his entire position in his latest 13F. Elon's dumping $8 billion worth of his own shares. Like, do you assign any alfalfa to these moves?
Yeah, it concerns me, but like I think
they're lagging.
Yeah, there's other data though. Like there's data you can get on CEOs who are buying or selling stock, for like insider selling or buying. I think insider buying actually has reached like pretty, like the selling peaked or bottomed out like a month ago, and it's kind of like,
aren't those insider trades usually like some pre-programmed like sequence or frequency of buying or selling?
I think the selling can be pre-programmed, but the buying can be instructive.
Interesting. Okay, that's good to know. Yeah, you're right. The selling is usually the one that's pre-programmed.
Yeah, it does seem like this data, if you backtest it and look back on it, looks relatively informative. Like I think the problem people have is they want like just one piece of data to be the magic button. If I just know this one piece of data, then I have everything. When the reality is you're forming like a very complicated picture using like multiple puzzle pieces and sort of using a bunch of 55, 45 probabilities to kind of swing things in one way or the other. And I like I said, like most of my success has come from not trying to heavily predict price, but to just get into really good setups where I know where I'm definitely wrong, and the downside is very limited, and the upside is like, just give yourself asymmetry. Like if you just put yourself in positions constantly where you have asymmetric upside or asymmetric downside if you're shorting, and that's a great strategy in a bear market. Like if you just keep putting yourself in those situations, you can be wrong a lot. And as long as you're risk management and you know how to like, you get entries and take profits and that sort of thing along the way properly, then you can do pretty well. I'm not saying any of this is easy, but that is to me the thing. To me, it's more of an asymmetry game. It's less of a number go up or number go down.
So go back to Armand. Armand the hodler. Armand's already doing the asymmetric bet. Like holding ETH long is asymmetric. Like it can go to infinity and it can only go down.
I think it would be good actually to touch on some, because we talked about a lot of active trading stuff, and like Armand, I don't think you have any desire to be even like a moderately active swing trader. You probably just want to be
I don't know if this is
more
a good
effective
frame for the question, but one thing that's been swirling around my mind is like, what would be the highest leverage, most effective thing somebody like me would do if they had 10 minutes a day.
I think you stick with as long of a duration as possible, right? You don't trade the 15-minute ETH chart. You trade like maybe the weekly, right? And then you use like weekly, large, high time frame, weekly moving averages. I think one of the biggest scams that people, I think just hodling is not that scammy. I think just DCAing constantly, no matter what, is a bad strategy. It's like if you've been DCAing Bitcoin since COVID, I don't even think you're up, even though you initially started buying at like $3,000 Bitcoin. It's not a good strategy. And like in my mind, there are points where you look at crypto and you're like, man, that's down a lot. I probably should buy here and it'll be good in the long run. And there's times when you look at crypto and you go, man, that's up a lot. Maybe I shouldn't be buying.
Yeah, so maybe it's like have a framework for when to just pause the DCAs.
It's the dynamic DCA, right? I think like if you look at crypto once a week, right? And like if you use something like these longer term moving averages, like the 100 week or the 200 week, right? Maybe when we're below the 100 week, you're buying like 2x your normal amount. Maybe when we're below the 200 week, maybe you've got like the balls on you to just be like, I'm just shoveling in a chunk here. Like if you're very long duration minded and you see 3-digit ETH and you're typically buying like $500 a week, but you have $100,000 to invest, really, I don't know. Maybe you just take like 40 grand of it and you just stick it in there. You're like, man, this is not a price that comes around like every year
like
or
what
two.
we had a month ago.
Yeah, like a lot of this like long-term alpha is it getting in at the bottom, like in these prices that just don't necessarily come around very frequently, and it's often painful to buy during those times. But that's like when you have to kind of just put the chips in, you know. But if you don't have these things we talk about, like these moving averages, which I think could be a little bit of a meme sometimes, but I think they're useful for people who don't have anything to anchor to. I really like the regressions. Like, have you ever looked at any of the logarithmic regressions? Bands, and you can pull up versions of this on TradingView. Like, it seems very obvious to me that crypto as a whole, like if you look at total crypto market cap, I think is like actually like a good thing to look at the whole thing. And you can subtract out like stable coins on TradingView, because I don't think you should care about stablecoin market cap adding to the market cap if you're trading, like trying to trade beta. If you just like look at those like kind of like the rainbow charts and these other meme things, I mean they're not like can't miss stuff, right? But it gives a basic investor who's only looking at the stuff like once a week or once a month, like just some frame of reference to go, this is kind of cheap. Like, assuming my long-term thesis is correct and this stuff isn't all going to zero, which none of us know, right? And we have to live with that. But like, assuming I want to be committed to this long-term thesis, and I do think this follows sort of network growth curves, laws of network growth, right? This is a pretty good price. Like, it's very hard to look at 17K Bitcoin and be like, and say anything other than, man, this looks pretty cheap on these long-term models.
Totally agree.
1700. Yeah.
Totally
So
agree.
I think I used this
17,000,
just
sorry.
recently.
Yeah.
I've used this just recently because I think I told you guys, I was like, I found a really good, it was a storage unit deal. And I was like, man, I really want to do this deal. And it was a higher minimum investment. But then I used like the logarithmic regression of crypto total market cap, and I made some assumptions on like what ETH would be, and I calculated an IRR, and I was like, well, you know, like I could just.
Is it going to beat ETH?
Yeah, it won't. It won't. So
what you can do too is, I mean, I do this sometimes. I take like the very bottom line of the regression fit. I'm like, where's this line in 3 years? And often that very bottom, like worst case, I mean, it's never the worst case. Let's be honest. Bad things can happen. But like, we'll call it the worst case line. It's very hard to like look at it when we're trading like kind of in that bottom range of the regression. It's very hard to like make any other investments, right? If you can stomach the volatility and the duration, right? And then when you get up to the points like last fall where we're like, you're like, yeah, it could go to 10K from here, but also it looks like it could go down to like sub 1,000. That's a pretty gross loss. Like, maybe I want to be shaving some profits here, and that's the harder part.
So Steven's answer is the dynamic DCA, which I agree with. I think that's a good way. I think another good way is selling covered calls, and I think that's a good way.
Yeah,
and then reinvesting the premiums into the asset that you like. and you're going to capture a much higher yield than you would by staking.
Yeah, it's a cool strategy if you can pull it off. It's obviously a little more advanced. I'm hopeful in DeFi we can like automate it and do it with like insurance and peace of mind for people. I think we're still a ways away from that, but like I like that because like I'm comfortable giving up upside to guarantee myself fixed monthly income to pay for stuff. Like I used to pay for my life by like farming, and farming's been dead for a while. I mean, I think it's coming back in a little bit, but like there's no great ways to just make a lot of passive income on chain. So I switched to writing options, and I was like, okay, well, I just need this much money for the more. And I'm like, I can go to $400 ETH, and I know that with this stack, I can sell calls and pay for all my expenses for years, and I'm comfortable like drawing down like 80% of my net worth, and as long as I can pay the bills and I have that all planned out, and then I can kind of wait for Valhalla to hopefully.
But you need to have a pretty big stack to support your entire like lifestyle off of writing options. But what you can do, like if you're a hodler, what you can do is like look at on a fundamental basis, at what point am I happy selling this ETH? You know, like in like what I mentioned, like
I love
73
that.
day
Big
period.
unlock today.
Like in a 73 day time horizon, at what point are you comfortable selling this ETH?
Yeah.
And it's like that becomes important. Like,
Yeah, I mean, you can use it to fund your lifestyle. You can use it to enhance your returns. You could use it to protect your downside. We also went over like perps and when to use them. I think this is really good. It's helpful for me. I drove down some notes I might implement.
I know I
This is a lot.
didn't even get into any of my shitcoin strategies.
I know we're
Be a
gonna have
fun
to.
one.
That,
I think
that could
that'd
be
a
another
fun
money
episode
episode.
we should do in the
just
future.
shitcoin
Like how to
play
how to
shitcoins.
find and trade
Yeah.
like small
Hell yeah.
coin gems. I think that'd be fun.
Small cap.
I feel like we could do like 10 of these episodes, honestly.
Awesome.
We'll do a part 2, part
That was
3.
very
We'll
good.
keep them coming.
That was
fun.
very good.
was
As
fun.
a almost entirely listener, Nick, great questions, and that was great stuff from you guys. That was a lot of unlocks. So just as a teaser, in the next episode, we're talking about eradicating humans from
That is quite the
planet
teaser.
Earth,
the virus.
the human virus
Are
of
they?
overpopulation.
Overpopulation.
So we'll see you guys there.
Adios.
Peace.
Bye, guys.